Hey everybody, Courtney Smith here with our weekly Wall Street winners, telling you what's actually going on in the market, showing you and revealing to you advanced stock analytical techniques, and then bringing you awesome winning trades. Let's dive right into it. Well, and this is advanced. Well, okay, maybe not. Okay. I as I'm sitting here and I was putting together this week's Wall Street winners, I kept thinking I could have repeated all of last week's. Really, the situation has not changed at all. We have this creepy, uppy bull market that's going on. We can see the purple predictors now kind of move more neutrally. Comments here exactly the same as last week. I've got nothing to add to what I said a week ago. NASDAQ, same thing. But notice how we're running out of momentum. That we're climbing, but it's microscopic climbing. And that usually means we're ready for a dip. This is an aggravating chart. We've been trying to break above that yellow line now for a couple of months, because climbing above that line and ending up with closing above that line would turn us seasonally bullish. Now the interesting thing here is that normally we would expect seasonal bullishness to end in May, and of course here we are halfway through or 2/3 of the way through April, and we still have not turned bullish. I mean, really, we've gone through the best 6 months of the year from a seasonal perspective, and we haven't been seasonally bullish. That's a pretty interesting situation, and actually it's a bit bearish. Now, we normally would sell in May and go away, and you can see there is expected, according to the Stock Traders Almanac, which is highly recommended that you subscribe to or get their almanac, at least get the almanac. We'd expect to see some type of a dip here in May, but then a re-rally back up to highs in July. So this is all developing very interestingly. The yield curve continues to bounce in a bullish direction, but if you look at the chart on the left, it's still way too flat. I cannot stop thinking that this is going to cause a major bear market 10 to 14 months down the road. Let's call it 12. Give or take a couple. But at least it's moving in the right direction. And it's moving in the right direction not because short-term interest rates are going down, but long-term interest rates are going up. Now, asset allocation shows that money's coming out of the bond market into the stock market. And in addition, people seem to want a bit of risk. They're not really going for the boring stocks. They're not trying to run for cover. They're saying, you know what? We kind of want some risky trades. We want some risky trades. Global shares, as I say, I'm beginning to get more bullish on them. And we've gone long now, global shares. You can see they're actually in a bull market that's now stronger than the U.S. market. And if that's the case, of course, I may be shifting much, much more focus not only on being long global shares ETFs, but starting to pick some individual stocks as well. Now, remember I showed you that money was coming out of the bond market and into the stock market. But look at what happened to the purple predictor in the last week. It was mildly bullish last week, but look at how it is skyrocketing now. It's moved to new highs on the move, even though the price action is muted. This could be a strong leading indicator that says that bond prices are going to go much higher over the near term. Now, remember, when bond prices go up, that means interest rates go down. If bond yields go down, that means the yield curve gets flatter, which solidifies the case for a major bear market. You see why this is also important? Our short-term indicators for the market show really kind of a neutral bag. It's kind of let's call it a dog's breakfast. Okay, the dollar popped up strongly on Friday, but the reality is that it's within a major boring sideways trend, and as a result, I cannot be interested. But on the other hand, gold broke down. We talked last week about the descending triangle in gold. It looks to me as though inflation is becoming more muted, and that is weighing on gold. Also, interest rates were getting higher. That weighs on gold. And the dollar popped up. That weighs on gold. So really, there was not a lot to be excited about in the gold market in terms of our various indicators. So we can see up at the top, that indicator, that moved down. The middle indicator is really flat, and the bottom one is kind of flat. So I can't get excited about being either long or short here. I'd say the weight of evidence is a little bit negative to gold. So I think it's best to really just stand aside. And then in crude oil, so I sent out a Trade Secrets. And Trade Secrets is basically a daily email newsletter that I put out. It's absolutely free. And I wrote a long essay on why I was getting out of long positions in crude oil, or tightening up the stops here. The Russian oil minister came out and said that he was and by the way, it's free. Just write to us asking for a free subscription to Trade Secrets, and we'll send that to you. It comes out almost every day, and it's all about trading. It's all about ideas of making money in the market. It's like the freebie version of Wall Street Winners, only daily. Anyway, basically, everything is bullish for crude, except the Russian oil minister came out and said, well, maybe they will abandon the oil production cuts in order to try to gain more market share. And of course, if the Russians bail out of that agreement to cut production, then we could see oil drop $10 fairly quickly. So what had been a fairly low-risk bull position is now a fairly high-risk bull position. So if you are long crude oil, in this case, I'd move the stop up to just under this week's lows, which is very, very, very tight. Now, Bitcoin, as you know, I think we're the only people that got long recently after being short. I can't find anybody else who played this perfectly the way we did for you. It's still a bull market. The purple predictor remains bullish. The price action remains bullish. Everything is bullish. And in particular, if we could break above that 50, let's call it 54.60 level, that would give us the impulse to move to a new high. What's going to happen, though, is we're not going to see this market embark and go back up to 10,000 or 14,000. We're not going to see that at all. If we get back up towards 6,000 or 6,400, 6,500, something like that, you're going to see a flood of Bitcoins into the market that will hammer the market down. So at this point, there's not a lot of upside potential. I mean, I guess $800 per Bitcoin is good upside potential. But the risks are getting higher and higher. We're getting closer to the end of this bull move than from the beginning. So yeah, stay long. Don't get aggressive at adding longs, and look to be taking profits up in the mid 6,000 level. Now, lots of courses coming up. Hopefully you're all coming to all of them. One thing we did have to do is we had to reschedule our upcoming Option Success School to September. But we do have the ones in Los Angeles and Orlando are filling up. I don't need to tell you about this. I don't need to tell you about this. So freebies, love having you here. Hope to see you next week. Fully paid up members, hang on just 1 second because I've got a new trade for you.